Welcome back. You're watching Unrivaled Investing. In this video, I want to walk through the logic on why we could be facing another financial crisis. So I first did a video on Silicon Valley Bank, warning that they were likely to be insolvent, unlikely for the stock to recover within 24 hours the bank was seized. I also did a video on First Republic, warning that they were likely insolvent as well. The stock price really hasn't recovered, down around 90% year to date. And this stems from the common problem that a lot of these banks were reaching for yield, buying long dated treasuries and mortgage-backed securities. And as Jerome Powell raised rates to combat inflation, these long dated bonds lost their value, resulting in serious impairments, serious losses, and in some cases insolvency for some small banks. Now, as you've seen this fear and this real concern relating to the banking sector, you've seen record drop in deposits for small banks following the Silicon Valley Bank collapse. In 1 week, you saw nearly $120 billion drop in deposits to 5.5 trillion, so around a 2% drop during the weekend, March 15th. Now, this was likely attributable to the concerns around Silicon Valley Bank and First Republic. So it's unclear if that just completely, slows down in the future or if that continues. But I think there are actually two key reasons why this could be a real systemic risk for investors to be aware of. So the first key reason is that a lot of folks are aware that, wait a second, you can keep your funds at much bigger banks and not have to worry about this because there's this assumption that they're too big to fail. And so if let's say you have deposits over that $250,000 insurance policy effectively from the FDIC, you're saying to yourself, why am I taking on that solvency concern with a smaller bank? Why don't I transfer those funds to a bigger bank? And that is one of the key concerns that you can see with the banking system deposit base. Another key big concern is that there are real alternatives now. For example, I personally keep my cash at Interactive Brokers, currently now yielding 4.3%. as of today. That's much better than the close to 0% that you have with the various deposit base from various banks. And they can't really jack rates higher. They can't offer much higher deposit base because they've been investing in loans that offer really low yields over the last few years. And they're long dated loans. They have these mortgages and such that, are super long dated. So they can't all of a sudden start paying depositors what you can get at, let's say, Interactive Brokers. Interactive Brokers doesn't have this problem. That's personally why I keep my cash there. Once again, if you're interested in Interactive Brokers, check the link below. So I'm getting that 4.3% on that cash. And the major banks, they can't do it because they have loan portfolios at 3, 4, 5%. And all of a sudden they would be underwater if they were to offer something like that. They would be facing huge, net losses on that. And so here it is, the impact to the small banking community is likely to slow the U.S. economy. And this comes from, a Wall Street firm, Goldman Sachs, warning folks like, hey, this could actually be a real impact on the economy. Some folks are even saying look, this could be a 1.5% impact, in terms of the equivalency of raising rates to the tune of 1.5%. And Goldman Sachs says, look, small and medium-sized banks, they represent 50% of U.S. commercial and industrial lending, 60% of residential real estate lending, and 80% of commercial real estate lending. So if you're looking at this, a huge takeaway is that you could see the commercial lending market really start to freeze up. And I'm going to talk about some of the data points from that. And when you're talking about commercial, real estate lending, you're talking about trillions and trillions of dollars. So if that freezes up, the takeaway, as I'll discuss later in this video, is there's no way for a multi-trillion-dollar market to freeze up and not impact the real economy, not ultimately impact you potentially. And so that's why it's so important to understand these small, mid-sized banks, 80% of commercial real estate lending. And so for them to be looking at deposit outflows, and then, they might even be saying, hey, we might need to sell some of our commercial loans because of our deposit withdrawals. What are we going to do? And so that is going to cause real additional pressure. And let's talk about that pressure. Let's look at some of the challenges we've seen recently. And just in the last few months, this is before the recent banking stress, we've seen several major investors, the quote unquote smart money, like Brookfield Asset Management and PIMCO, they had investments in various different properties, and that they've effectively let these properties default on their mortgages. They effectively said, look, these office properties, it's not worth it. You see PIMCO owned office landlord defaults on $1.7 billion mortgage. Brookfield defaults on 2 Los Angeles office towers. And you're looking at $92 billion of office mortgages maturing this year. And so this is a sizable challenge, partly because interest rates have moved higher, but it really is a lollapalooza. It's a combination of various different things. Work from home loan is definitely a key aspect with commercial real estate in terms of, vacancy, how many people are actually going back to building, how many people still need to, sign up for new leases. You're looking at higher interest rates. That's going to be a problem with mortgage refinancing. And more broadly, the disappearance. And this is what you're just going to start seeing. And this is why I'm warning investors. This is the logic of how we could be facing a real some sort of financial crisis, is because as regional banks pull back on credit, it's going to result, especially when they represent 80% of the commercial real estate market in terms of loans, this can result in a cascading problem for commercial mortgage-backed securities and commercial lending, the commercial real estate market. And as a proxy, the commercial mortgage-backed securities, you could look at their pricing, which has just been cascading lower just in the last few weeks, dropping like a rock. So what's all this mean for you? First of all, in full disclosure, this is not financial advice. Second, unlock your investment potential at unrivaledinvesting.com. Discover compelling companies, get real-time portfolio updates, and engage with me and our active community on our Discord server available for annual subscribers. Don't forget to check out our educational series on financial statements and valuation analysis as well. And so I think there's a few key points that investors need to understand. The first is that the Federal Reserve does not have your back. They've had it for decades. Every time there's a crisis, they can quickly lower rates, just print more money. They can't do that now because inflation is just too high. And that is the real challenge that we're facing now, of how much pain can the system tolerate before they capitulate and say, you know what, we're going to have to intervene because there's so much pain. But they're going to willingly, cause potentially more inflation, or to potentially say, hey, we know inflation hasn't gotten down to the 2% that we wanted to. What are we going to do? Or what's the concern that inflation all of a sudden jumps back to 3 or 4%? They're going to have to tolerate that risk because the pain is so great. That is the concern, and we're not there yet because Jerome Powell just raised rates earlier last week. The second key aspect is you are definitely seeing signs of a credit crunch. Based on all these banks seeing conversations and language about the commercial property market freezing. I mean, there's, once again, no way you can have a multi-trillion-dollar market. Some estimate the commercial real estate market is a $20 trillion market. There's no way you can have a multi-trillion-dollar market freeze up or have significant problems and not impact the broader economy, not impact employment, not impact potentially a lot more asset classes. And so I think that's just super important for investors to understand. So what can you do to prepare for this? Personally, I think one of the really big important things, if you're a stock market investor, I've seen the rally over the last few weeks. I've seen the rally recently. I just don't think it's pricing in what is very likely to be some sort of credit crunch. I mean, the Federal Reserve does not have a lot of these banks back. They might be providing some sort of emergency financing, but I don't view this as, a really good solution long term. I don't see the money printing that will result in sort of figuring out these problems or solving the holes in their balance sheet. And so that's the first thing. I think the stock market is not pricing this in at all, and a valuation for the S&P 500 in the high teens just doesn't cut it, in my opinion. The other key point for you to consider is that the truth is the opportunity, cost for holding cash just keeps getting higher, because you're like, well, wait a second, like my cash is now yielding more and more. Why not just hold it? Because it's not like the opportunities in the stock market are getting like crazy cheap. Once again, the broad market trading at what has historically been a above average multiple. So I'm looking at this and I'm thinking, either build my cash balances or, for the things that I call out to my subscribers at unrivaledinvesting.com, I want to make sure I have something that has a really solid sort of valuation backdrop, and where I can be certain, like either there's liquidation value, and I'm calling out things that trade below liquidation value. I'm calling out things that I think can have 100 or 200% upside. So look for things where it's just tremendously compelling upside, because you're now starting to see the signs in the credit market that there are real problems potentially ahead. So I wanted to warn investors, to share my logic. Maybe I'm wrong. Maybe the stock market's seeing something that I'm not, but I think there are real problems that investors should be aware of. If you disagree or think that I'm being too bearish here, I'm not trying to create, fear and drama here. I'm trying to walk through my logic. If you feel like there's a fundamental flaw in the logic, I'd love to hear it in the comments below. Look, everyone's learning, and I'd love to hear your logic as well. Thanks so much for tuning in to Unrivaled Investing.